The current trading price for SMX, Security Matters Public Limited Company, sits at precisely $120.00 USD, marking a sharp intraday decline of $23.00 USD, or approximately 16.08% as of this very moment. To the uninitiated observer, seeing a stock trade at triple digits might suggest a company in the upper echelons of stability, perhaps comparable to the likes of Apple stock or a quieter day for Tesla stock. But the reality unfolding on the charts today is a masterclass in the deceptive optics of financial engineering. This is not a standard correction or a buy-the-dip opportunity in the traditional sense. What we are witnessing is the violent recalibration of a stock that has undergone aggressive structural changes to maintain its place on the NASDAQ. The expectation for many retail traders, especially those using accessible platforms like Robinhood or SoFi Invest, is that a higher share price equates to a higher quality asset. The brutal reality, however, is that this price point is largely the result of repeated reverse stock splits, a mechanism often used by distressed companies to artificially inflate their share price to meet exchange listing requirements. The 16% drop we are seeing today is the market digesting the disconnect between this engineered price and the company's underlying fundamentals. It creates a tension that is palpable. The ticker says premium, but the price action screams distress. While you might be tempted to open your Fidelity mobile app or log into your Interactive Brokers trading account to catch a falling knife, it is crucial to understand the mechanics at play here. Today's volume is surging, not because institutions are accumulating positions for a long-term hold, but likely because algorithmic traders and high-frequency systems are capitalizing on the volatility. When a stock like SMX moves this aggressively, it triggers a cascade of activity across investing sites. You have the momentum traders on Robinhood app chasing the volatility, hoping for a dead cat bounce, while more calculated capital on platforms like Interactive Brokers might be looking at the arbitrage opportunities or short-side setups created by this liquidity event. The price of 120 USD is a psychological anchor. It feels significant. It feels weighty. But if you strip away the reverse splits that got us here, the effective value per share for a long-term holder is a fraction of a penny. This is the expectation versus reality gap that traps so many. You expect the price to represent value. The reality is that it represents survival maneuvering. Let's talk about the broader market context hitting SMX today. We are seeing a risk-off sentiment in the microcap and speculative tech sectors. While blue chips might be holding steady, high beta names, stocks that move faster than the market, are being punished. SMX falls squarely into this category. It operates in the supply chain visibility and circular economy space, a sector that sounded fantastic during the cheap capital cycles of previous years, but is now facing the harsh scrutiny of a high interest rate environment. Investors are no longer willing to pay for stories or potential 5 years down the line. They want cash now. SMX's drop today is exacerbated by this macro shift. It's not just about the company, it's about the market's appetite for risk. When you look at your Schwab Intelligent Portfolios or consult with Fidelity Wealth Management, you'll notice a distinct shift away from these speculative plays toward quality and yield. This macro pressure acts like a heavy blanket on stocks like SMX, suffocating any attempt at a rally before it can even begin. Now let's step back and look at what SMX actually does, because the business itself is fascinating, even if the stock chart is terrifying. Security Matters specializes in the digitization of physical objects on the blockchain. They have developed a technology that can mark any solid, liquid, or gas with a unique chemical barcode. This marker can then be read by a specialized reader and the data stored on a blockchain ledger. In theory, this solves massive global problems: counterfeiting, supply chain transparency, and the verification of ethically sourced materials. Imagine being able to scan a gold bar or a plastic bottle and know exactly where it came from down to the molecular level. That is the promise. It is the kind of narrative that gets people excited about online investing and encourages them to invest online in what they hope is the next big thing. The expectation is that this technology will become the global standard for the circular economy, adopted by every major manufacturer from fashion to mining. However, the reality is that commercial adoption is slow, capital-intensive, and fraught with regulatory hurdles. While the company announces pilots and partnerships, the revenue conversion has historically lagged behind the burn rate. This cash burn is the elephant in the room. Developing deep tech solutions requires massive R&D spending. To fund this, companies often turn to the equity markets, issuing more shares and diluting existing holders. This dilution is the primary enemy of the long-term shareholder. Every time new shares are printed to raise cash, your slice of the pie gets smaller. This is why you often see the stock price slide even when the company announces good news. The market is pricing in the cost of the capital required to achieve that news. It is a dynamic that every user of Fidelity Brokerage or Robinhood Investments needs to internalize. A great product does not automatically equal a great stock. If you're watching this price action on your Fidelity trading platform or checking the charts on SoFi Active Investing, you might notice the erratic nature of the bids and asks. The spread, the difference between what buyers are willing to pay and what sellers are asking, is likely widening. This indicates a lack of liquidity, meaning it is hard to enter or exit a position without moving the price. For a retail trader, this is dangerous. You might see a price of 120 USD hit buy and get filled at 122 USD seconds later, only to see the bid drop to 118 USD seconds later. This slippage is where the smart money eats the dumb money. The algorithms that dominate Interactive Brokers stock trading are designed to exploit these inefficiencies. They know that retail traders on the Robinhood app are often using market orders rather than limit orders, and they front-run those trades. It's a game of milliseconds, and in a stock like SMX today, those milliseconds cost money. Engagement break. I want you to pause for a second and look at your own portfolio. Comment below how many shares of SMX or similar high volatility tech stocks you currently hold. And honestly, has the story of the technology kept you in the trade longer than the technicals suggested you should stay? It's a common trap, and discussing it helps everyone learn. Returning to the analysis, let's consider the sector momentum. The circular economy and supply chain security themes are technically strong. Governments worldwide are pushing for stricter regulations on waste and sourcing. The EU's digital product passport is a prime example of legislation that should, in theory, send SMX to the moon. This is the expectation driving the bulls. They see the regulatory tailwinds and assume SMX is the boat that will catch the wind. But the reality is that legislation moves at a glacial pace, and compliance costs can crush smaller players before they ever get a seat at the table. Larger conglomerates are also building their own internal tracking solutions. If a massive logistics company decides to build a tracking system in-house, they don't need SMX. This competitive risk is often overlooked by those browsing investing sites looking for a moonshot. We also need to discuss the psychological toll of a chart like this. When a stock undergoes a reverse split, say a 1 for 20 or 1 for 100 to get the price up to 120 USD, it erases the visual history of the decline for the casual observer. A chart that looks like it's trading at a healthy 120 USD might mask a 99% decline over the last 2 years. Brokerages like Fidelity or Schwab Intelligent Portfolios will adjust the historical data, so the chart looks continuous, but the long-term holder knows the pain. If you held 1,000 shares at $1 and they did a 1 for 100 split, you now have 10 shares at $100. The value is the same, $1,000, but if the stock then drops 16% like it did today, you are losing money on a much smaller share count. It feels different. It feels like you have less skin in the game, which might paradoxically make you hold on longer because it's only 10 shares now. This is a cognitive bias that professionals on Interactive Brokers trading platforms are trained to ignore, but it wreaks havoc on the retail psyche. What is the future outlook for SMX? We have to look at the cash runway. The most critical metric for SMX right now is not its daily trading volume or its latest press release, but its cash burn versus its cash on hand. If they have enough cash to last 12 months, they might be able to weather this storm and land a major commercial contract that validates the tech. If they only have 3 months of cash, another capital raise is inevitable. This is the binary risk. The upside scenario is that their marking technology becomes the Intel Inside of the recycling world. Imagine being able to scan a plastic bottle and know exactly where it came from down to the molecular level. That is the promise. It is the kind of narrative that gets people excited about online investing and encourages them to invest online in what they hope is the next big thing. The expectation is that this technology will become the global standard for the circular economy, adopted by every major manufacturer from fashion to mining. The reality, however, is that they become a zombie company, listed on the exchange, technically alive, but slowly bleeding out cash